Let's look under the hood right now, and with some of the individual movers. Christine Aquino, Bloomberg Managing Editor for Markets Live. Christine, let's start with the banks, starting off the earnings reporting season. And the banks, what is the big takeaway for you, first off?
Well, John, the big takeaway is that banks do love all this volatility. Record stock trading revenue for JPMorgan and Morgan Stanley. So JPMorgan seeing a 48% increase in that revenue to more than $3.8 billion. Lisa mentioned that there is evidence that they're preparing for an economic downturn that's very evident in what they're doing for the money that they set aside for soured loans. That's up to $973 million, way more than the predicted $290 million that analysts saw. And that is definitely one of these signs. You know, they're shoring up their coffers and they're trying to prepare for what's to come, which is potentially considerable turbulence, according to CEO Jamie Dimon.
Now, this record volatility, this wasn't accounting for the most recent week, right? Because the quarter ended a couple weeks ago. So it's interesting that even before this week, they're still profiting.
So they're going to see more trading profit
in the next quarter.
So they're going to see more
of it, basically.
Yeah, I think so. So there's going to be a lot for investors to like heading into the second quarter. I mean, that shares though are kind of flip-flopping. They're up just over 2% at the moment. We did see some pre-market weakness for JP Morgan. So a lot of volatility again, but this is the sort of environment.
Okay, that's the trading part. What about the other parts where the banks make money or lose money? How's that business doing?
Yeah, well, I mean, they're still kind of, it seems like they're still doing well. Looking at Morgan Stanley, for instance, they're also hitting a record trading revenue, right? So they saw $4.13 billion. But the reaction to that seems a bit more lukewarm. I think we're seeing for Morgan Stanley, though, higher expenses for their part. That's at $12.1 billion for non-interest expenses because of the fact that they laid off about 2,000 employees in March, and that added to their severance costs of $144 million.
Okay, so in terms of cost controls, who's doing what? That's a big theme too?
Yeah, definitely, John, because I think, heading into the second quarter, we are seeing a lot of volatility. That's definitely going to be good for banks. But then it's a question of, are they going to be able to keep those costs under control and kind of really maximize the revenue that they can reap from what's happening in markets? And so, yeah, there's a lot to be said about differentiating between these banks. If they're all generating really sky-high revenues, then it's really going to be all about how they manage the cost side of things. And that's probably what investors are going to be looking at in terms of kind of which bank is doing the best and where are they going to be putting their money for investors.
All right, what else are you looking at?
Looking, of course, at some of the casualties of this raging trade tensions between U.S. and China. Texas Instruments very much caught in the crosshairs there. That's down more than 7% today. And that comes after we heard from a Chinese semiconductor body, which said that the government will put tariffs on chips based on where they're manufactured rather than where they're shipped from. And so what that does is it does clarify the kind of costs that Texas Instruments, companies like Intel will incur if these trade, tariffs will push through between U.S. and China. But it also makes it very clear that the cost is going to be much higher than what they're dealing with now. And that's really weighing on Texas Instruments shares.
Christine, you're the managing editor of markets. What else are you looking at? There's a lot going on in markets. But
there's a lot going on in markets. I mean, I love a macro story. So, treasuries, John, you mentioned earlier, I mean, that's still very much in the crosshairs. We're seeing yields higher across the board today, particularly in the long end of the curve. Last I looked, it was 10-year yields up about 8 basis points, 30-year yields up about 6 basis points. And that really speaks to kind of, I think, the lingering inflation concerns that are stemming from this potential trade war that's emerging, particularly between the U.S. and China. It's the two world's biggest economies, John. I mean, and Emily, I think it's really impossible for the global economy to not feel the impact of that, particularly when it comes to inflation.